State of the market, how to trade the SPY. Today we're going to look at what happened in March, and we're going to look at a novel way of trading the SPY that's quite accurate in terms of predictability and quite profitable in terms of ROI. And we'll start with that. So let's take a look at the SPY over the past 30 days. And actually, let's look at the SPY yesterday, see what happened. The past few days, we've seen a gap in the SPY right here between this green candlestick and the red candlestick. We had a small gap. That's obviously an area gap, and that was tradable. All you'd have to do is buy a put option or short the stock. And as you can see, yesterday that gap filled. We started right here, right below that gap, and that would have been your time to take profit. So that's at about 204, and we would have recognized the gap, let's say at the latest at open here. So you would have been 206 down to 204, and that's a quick $200 per every put option had you bought a put option. But more importantly is the fact that these small area gaps in the SPY where you see a gap between the candlestick with low volume and the newest candlestick not being too far out of the trading range, you can see that it's pretty close to where everything was trading anyway. That's an area gap, that's an up area gap. And if you go to short or buy a put right after that, you generally want to see a green candlestick and then a red candlestick or some other combination. And I explained that in the Gap Game Plan 2.0, which will be out soon. The combinations of candlesticks that can give you more confidence that the gap is going to fill. So we saw that gap, and if you're wondering how to trade these gaps on the SPY, it's pretty simple. All you have to do is the day after that gap, so that would be this day here, on open, buy a put or short the stock. Now if you're shorting the stock, I've written an algorithm for that. If you're shorting the stock, we can look at how that'll work on the SPY. So I'm going to run this algorithm real quickly. It'll tell us how this trading strategy ends out working. And after we run it, here's what we get. So that 0.7 right there you see, that means 70% of the time the gap will close within 1 day. So 70% of these gaps are only not day trades, but 1 day intraday trades. So that would mean like here that the gap didn't close yet. But 70% of the time it does. So 70% of the time you see this candlestick pattern, the gap will close the next day. So you can basically day trade. You buy the put on open and then you sell it back as a day trade. So yeah, it is an intraday trade, but you use the intraday candles to determine when to get in on that trade. And 70% of the time you'd be able to exit that position within 1 day. And if you make this your trading strategy, just shorting the stock, by the way, which is less profitable than buying puts, just shorting the stock will give you a yearly ROI of nearly 60%, which is extremely high, especially considering that the SPY only gives you like 7% per year if you hold on to it and don't touch it. This is a day trade. You make many day trades throughout the year. Whenever you see these gaps, you day trade downward, and this is what you get. It's 55, I think, % ROI, and your max drawdown on 1 day is going to be like 5%, so it's negligible. And of course, you can make this accuracy more than 70% if you hold on longer. For example, on this trade, we would wait 1 more day. You wouldn't get out here. You could get out here and you take a small profit, but more likely you'd wait until this gap fills, which was on the open of this day, and then you can get out on the open and you would have made $200. So there we go with the SPY. Now, year to date, the SPY is up. I believe if we look at the 90 days, well, it's up year to date. Let's see. So year to date, January here, SPY is up so far in 2016, but it's not at its top yet. Overall, it's down, and I think the QQQ is overall down. Yeah, the QQQs haven't risen as far as the SPY. So remember, the QQQs are for NASDAQ and SPY is for the S&P 500. NASDAQ has lagged behind the S&P in this regard. And NASDAQ, I believe you can make the same type of trade, but as you can see, NASDAQ reacts a bit differently than the SPY. It's typically more volatile. So the SPY is a safer trade, but you got that same pattern right there. I prefer trading the QQQs. Right now I'm short on the QQQs. Got a put option. QQQs are overbought at this point. They've got to pull back eventually. So I have a long dated QQQ put, and hopefully that will pay off soon. But there's no reason you can't day trade the QQQ while you have a long or short position open. As long as your long-term position is open, you just treat that as a long-term trade. Always remember why you open the trade at the beginning. Don't dilly-dally and don't flip-flop your trading strategy based on the day-to-day movements of the QQQ if you have a long-term trading strategy. So for me, I'm expecting a market crash or a market correction. I'm short on the QQQ overall, but that has not stopped me from day trading long on the QQQ and the SPY and the Russell. Now, in terms of news, this week we got some, on Friday is probably the most important stuff. Friday has a lot of information, news on what happened with the jobs in the US. So we got non-farm payrolls down, unemployment rate up, hourly wage up. So a little conflicting there. We are losing jobs. Unemployment's going up, but so is hourly wage. Still, it's not a lot. 0.3% is not a significant increase. And when you realize that the majority of Americans cannot take $1,000 hit to their bank account, you've got a problem in the US. I believe we're already in a recession. The stock market has yet to reflect that. Soon it probably will. Right now, the stock market is being pumped up by artificial means. But the fundamentals of the US economy are quite poor. We should let a recession happen, but the banks are not letting that happen, probably because it would make things even worse in their opinion. But all this monetary intervention has pushed the stock markets up, and how much longer it's going to stay up is the question of the hour. Now, in terms of manufacturing, we got manufacturing, ISM manufacturing up, construction spending is down, consumer sentiment is slightly up, and motor sales are down. And remember, motor sales are a pretty important leading indicator of the economy. So that's what we got. We got a bunch of conflicting indicators, but most of it, in my opinion, would be bearish. Not for the market, but at least for the US economy. Like I said, the market's being bolstered by artificial means. Now, we looked at the QQQ and the SPY. What about the Russell 2000? Remember that the smaller caps tend to move more quickly, so I like to use this as a better indicator for what's going to happen in the future. So IYM, why am I looking at IYM? What's the Russell 2000? IYT? ITM? I just day traded this. I don't remember what it was though. Russell. Oh, I'm gonna have to go Seeking Alpha. Too many tickers in my mind. But the idea is, if you want to, let's see, Russell 2000 IWM. There you go. The idea is IWM is more forward-looking than the SPY or the QQQ. It tells you how liquid stocks react, because money tends to flow out of these stocks before a market crash and into the stocks when a recovery comes. So IYM tends to lead the SPY and the QQQ by just a small amount of time. And as we can see, IWM is up, and more or less it is trended the same way as the SPY. Alright, now what about, well, we're going to look at IYT. IYT is the transportation ETF, so it's all the transportation stocks. And if you remember from the last state of the market, we found an interesting trend where we had a down gap every day, down gap every day, down gap every day. Last time I said it's probably tradable, but I was worried that we're getting in too late, and I believe it was this day where we saw something similar to a down gap but not a real gap, and on that day things changed, so clearly this was not so tradable, and now we've got an up gap followed by a down gap. It's become a little more volatile than it was when we looked at it at this time, so we missed this nice decent day trading pattern, and now we've got another gap ahead of us. So let's take a look at that gap, IYT. So there's our gap, and it's a hammer candlestick. And please take a look at the recent video on hammer candlestick patterns that I made, and you'll see how to trade these. But this looks like it might reverse and go upward, and that would make sense from a gap perspective because this looks like an area gap. We got low volume, and you see how there's a tiny gap between these two. If you look at the low, it's 141.81, and the high here is 141.55. So we got a little bit of space in between those, and it'll probably fill. But whether this is a good day trade or not, because the gap is really small, we don't really. I don't recommend this as a day trade because you don't have a lot of leverage between these two prices to make a decent day trade. Of course, if you're playing with high volume and you want something almost certain, you could do this, and you could probably set your take a profit around 142. I'm probably not going to be day trading this, but it's interesting to look at anyway. Let's move on to, let's look at the VIX. So the VIX has been pushed down by a market rally. Now, oddly enough, a market rally pushes down volatility, even though the rally itself might be highly volatile. It's ironic, but that's how the VIX works. The VIX is always safe to short with puts because you have limited risk, but the VIX can spike, and when it does spike, it spikes quite high. So right now, I'm holding a call option on the VIX. I'm thinking it's going to spike when that market correction hits. I'm going to take my profit that way. Also, if you look at the longer term stochastics down here, these are the slow stochastics, you see that it's oversold. Let me make that bigger. So the VIX is oversold. We have this red dipping down there. When they cross, that's a pretty good buying signal. I'm in early. You can get in when the red and the green cross over one another, and that's gonna probably be indicative of a spike in the VIX. But the VIX has looked pretty much the same every day, just downward trending. Some days more than others, but that's the VIX these days, unfortunately. Unless you're on puts, and of course you can always buy puts. It's always safe. Make them long term, ride it downward. You might want to sell the weeklies under it. So for example, let's say you buy a VIX put for April. You might want to go out further, but let's say you want to buy it for April. You buy, let's say you buy the $17 put, and then the weeklies, like April 8th, you go to April 8th, and then as soon as you sell the $17 put, or sorry, you buy the $17 put, you can sell one of these lower ones. Obviously you wouldn't do it for these because you make pretty much no money, but you can also make it a same dated one via a vertical spread. So you got all these vertical spread puts, and you can see they're cheaper than buying the puts outright. And if you don't think the VIX is going to dip below, for example, 15, you could do that. Question is whether that sold put is actually worth any money, so you might want to go out further than that. Again, pretty much always safe to short. VIX puts are pretty cheap anyway, so you might just go with a straight put. I am long on VIX, as I said, because I don't think it can continue downward for such a long time. Eventually something's got to give. It's going to be a piece of bad news or something, or one of the people who work at the Fed is going to come out as hawkish on interest rates, and that's going to spike the VIX. It's eventually going to happen. Now, some interesting new developments in light of the chronic upward trend of the SPY is that a lot of the indexes or stocks or ETFs that should have gone downward in light of the SPY, because there's that correlation, have become kind of uncoupled with the SPY. So for example, when the SPY goes up, when the market goes up, bonds should go down. TLT is the 20-year Treasury bond ETF, but bonds haven't really gone down. They've trended sideways. In addition, the yen should go down when the SPY goes up. When you look at FXY, the yen has not gone down. Same with oil. Oil should go up, but it's been going down. So don't think of these as correlated to the SPY, at least for now. Trade these independently. Don't think that because the SPY is going up, oil must also go up, so it's a good time to buy oil, or that bonds must go down, so it's a good time to short bonds. Don't think like that. Look at these as individual commodities or equities. So that's what you got. As for positions on these, I might take a position on FXY if I weren't living in Japan, but the other two, oil and TLT, I'd probably stay away from. I think the yen will continue higher. So if I were going to take a long-term position on the yen, I would just buy FXY or buy a call option on FXY. If I think it's going to move slowly, I might just sell credit spreads on the FXY, bullish credit spreads. But for now, I'm not interested in this at all. Let's take a look at the dollar. UUP is a decent ETF to buy if you want to trade the dollar. The dollar's strength has been going down, and I think it's going to continue downward, at least until we see interest rates rise. So as long as the Fed remains dovish on interest rates, in other words, they don't plan on raising the rates in the coming months, UUP, or the dollar index, is going to continue falling, and the dollar is going to become weaker as a form of currency. Now, is this tradable? Of course it's tradable, and you could trade it, but it's going to have to be a long-term trade. So it's short outright the UUP and hold. You might want to put a protective call above that. What about gold? Gold has done pretty well in the past, I guess in the past week it's done pretty well. It doesn't look like it, does it? But we had this big gap right here that looked kind of like a breakaway gap, but that gap filled, and we got another gap that's probably going to fill. So right now, if you want to day trade gold, you should be long. If you want to hold on to gold as a hedge against a market crash, be long. I don't think anybody should be shorting gold right now. So that's my opinion. But we got another gap right here in gold, so it looks tradable. If we trade just as a pure gap trade, the low is at 17.6, so that's about $1 above this. We should be able to make $1 per share. So obviously you'd buy a call option with a high delta. So let's say you want to trade gold, choose a call option, look at the delta. Here's the delta. Of course, the higher the price, the higher the delta. So what I like to look at when I day trade is I look at the delta per price. Now, obviously, you can calculate those by yourself by looking at the delta and then dividing that delta by the price of the option. I use this Platinum Options trading platform. Type in gold, hit call, and what we'll see is a bunch of ratios, and we can actually arrange all of the calls by delta divided by cost. So I'm going to look at that, Greeks, delta divided by cost, and here you go. It's usually your best delta divided by cost options are very cheap and out of the money. But I've done these before, and they work out as long as you buy enough deltas to where you're getting 100. So you would have to buy 50 of these, which would equal 50 times $5. So you're spending 250 bucks to get 100 shares of gold, or at least the equivalent of that. You can also do a synthetic option. If you don't know what that is, please look at one of my videos about that. But the problem with buying a lot of these, let's say you buy 20 of these, well, each contract is going to cost you commission, so it might not be worth it. You might want to go with something that's a little more expensive. For example, look at this one. Delta here is 10, so you'd only have to buy 10. Delta here about 25, so you'd only buy 4. So that might be the best one in terms of your commissions. You got to look at your individual commissions per contract. So that's up to you. But I've been successful day trading large quantities of these way out of the money, low delta options because of the delta versus cost, and then selling at the end of the day. So if that's what you want to do, choose whatever you can find that makes sense to you, that has both a high delta and a high open interest. You don't want to buy this 38 open interest because it's not very liquid. So you might want to look at, for example, this one. delta is actually quite high. You don't have to only have to buy one or two. It costs you $500, so it's a lot more expensive. So there you go. It doesn't really work out that well when you compare it to these. And of course, what I do is I just look at the open interest here and see if it's high enough. If it's above 100, generally I believe it's liquid enough. So this one's liquid enough, and just buy that, hold enough to where your delta is now 100. Remember, deltas are additive, so you just multiply that by 50, you get about 100. Now you've simulated holding 100 shares of gold, and that should close. That might be a day trade I open on Monday actually. So there you go. That's gold. Silver is, I think, is pretty much the same, but silver barely moves compared to gold. Look, silver is trading in the tens. Gold is trading in the hundreds. So if you want to be day trading, you got to be day trading gold. Silver is not expensive enough to warrant day trading. Now gold overall, over the past week, it looks pretty good. Of course, we got that gap here. This gap is already filled, but this is not. But let's say the 90-day overall, gold has shown its best quarter yet in recent times. So gold has been chronically trending downward until recently. It's 180 days. Let's look at 2 years. So it's been going downward for a long time, and then suddenly it spiked, and we've seen a very nice return on gold. So if you're going to be long gold, try it with a call option, because we don't know if this is just a temporary blip. Probably not, because there's a lot of fear in the market right now. People are buying gold because they think it's a safer investment than bonds at the moment. A lot of people think this, and there's a lot of people who are always long on gold because they just believe that one day fiat currency like the US dollar is going to fail, and then the only thing worth money is gold. But those people generally buy physical gold. Remember, the gold ETF can't be redeemed for physical gold unless you have a huge amount of money invested in it, and even then it's a hassle. So if you're one of those people who think the world is going to go to hell, your best option is simply to buy physical gold. I use gold as a hedging tool, the ETF gold as a hedging tool. I don't own physical gold, and I use that as a day trade once in a while. It's not so volatile. It's not a great day trading stock in terms of risk versus reward, but it's pretty safe, just like that SPY day trading strategy I just showed you. Now, I've been talking about a market crash for a while, so I mean, we should take a look at this past dip. So what happened was, in December, the Fed raised interest rates, and people freaked out. The market crashed, as it should have, because we really are in a recession. Now, why did it bounce back? Central bank intervention. But it took the world's 4 biggest central banks, which are those in China, the Europe Central Bank, the Bank of Japan, and the Federal Reserve. All of those central banks had coordinated efforts to drive equity prices back up. So, for instance, the Bank of Japan started a negative interest rates policy. The European Central Bank put out 80 million euros worth of stimulus, and as we know, the Fed has been very dovish on interest rates, which has driven things up. So there you go. This is artificially inflated. What should be happening, though, really is we should have been in a bear market. It's just this intervention from central banks have pushed us higher. And how long can that last? Well, they're really out of tools. They've used everything they can. And I think it's just a matter of time before the market dips again, just like we saw here. And if it does dip, we should first see, again, a drop down to the 185 level around there. So that's a lot of profit for anyone who's got a nice speculative put option on the SPY or the QQQs. I like the QQQs simply because it's more volatile. Alright, so let's move on to what most people want to hear. What are some good stock picks for the upcoming week? Well, most of my stock picks for the upcoming week are bullish. Now, they're bullish because, well, simply we got the Fed being dovish. And if the Fed's dovish, stocks go up. So let's take a look at some of those bullish picks. And remember, this is for the upcoming week. These are swing trades or possibly day trades. They are not long-term investments. So the QQQ, like I said, I'm short on the QQQ, but the QQQ is probably going to go up more, and because it's volatile, it's a decent day trade. You could do the SPY as well. You might buy a call on that at the market open, buy it, and then at the market close, sell it. You should come out with about $100 per option, or almost 150 in case of the QQQ yesterday, and the SPY same. So that's a decent swing trade or a day trade. I think it's going to go up. The general market is going to go up in the upcoming week. If you want to be really daring about it and you don't want to use call options, what you can do is just buy outright the TQQQ, which moves pretty quickly and is decent for a day trade as well. Now that assumes that you have a lot of money. You'd have to put down maybe 10 grand for a day trade on the TQQQ, and it's pretty risky, like I said, because one day this is all going to smash downward. Now if it smashes downward and you're not using a call option, your risk is 10 grand. But if you're using a call option, your risk is probably something like $200. In terms of ETFs for the market, in the general market, we're going to look at XLP, which is the ETF for consumer staples, and this should go up even if there's a market problem. This should continue going up, or at least not be hit so hard. So consumer staples tend to do well regardless of the market, and right now we've got this huge bullish engulfing candlestick, and that's predicative of an upward trend the following day or the following couple days. So this would be a nice swing trade or day trade, but be warned that the stochastics are now in overbought region, and once we see that red hit above 80, then we're really playing with fire, and it's probably a good idea to take your profit and get out. Of course, it generally won't fall, as the stock generally won't fall until the green stochastic line starts to trend downward. So right now we're pretty good for a swing trade. I wouldn't trade this because the price is too low, but if you want to buy the XLP ETF outright, just do so. It's a decent swing trade that way. I wouldn't do it because I mainly play options, and the movements are not good enough for me. They aren't volatile enough for me. Now another good sector is the healthcare sector. That's XLV for the ticker. And again, we have a very strong bullish engulfing candlestick, even though there was a low volume day. And this one's actually a bit safer because we're not in overbought region yet. So if you want to hold on to this is a decent swing trade or position trade. And if you want something more volatile that would be better for a call option, you can look for individual stocks within the healthcare sector or within biopharmaceuticals. I think Merck looks pretty good. Again, we have that bullish engulfing candlestick. We have a gap that's already filled, and again, it's not overbought. And Merck tends to move a lot better than the XLV, so this would be a decent swing trade for anyone looking for a swing trade in the upcoming week. Now, in terms of bearish positions, I only have two bearish positions for swing trades. One is Baidu. We see a breakaway gap here, but I think this gap will eventually fill. I think Baidu is artificially inflated, and as we know, the People's Republic of China's central bank has been outright buying Chinese stocks. So, I mean, it's out there, it's direct. The government uses its own money to buy stocks to inflate the market. And the reason I like this as a downward, as a bearish trade, is because of this hammer candlestick pattern. Now, again, you can go back to that video on hammer candlestick patterns and see why a hammer at the top is pretty dangerous. The shadow here is not very long, but the shadow, what it does is it represents the strength of the bears on a single day. If you look at the daily for the Baidu, go back to the daily, we saw it started off downward very strong, and then money was pumped into it that brought it back up. But within a single day, we could have made, let's say we bought it at the close, a put option, 191 all the way down to 186. That could have made us $500 per put option. Now, whether that happens again or not is questionable, but the fact that we have a hammer candlestick pattern, which generally looks like downward trend and then upward trend, tells us that there is a lot of bearish sentiment for Baidu, and as you can see, the volume is mainly selling. So a lot of the bears were pushing it downward at the beginning, and then money came in from somewhere. It's a mystery. Could be the Bank of China. But money came in from somewhere to push it back up. Now, if that happens every day, we might have a pattern, and I haven't looked at that actually, and it doesn't, but it would be interesting to see a pattern like that where we have a down gap at the beginning of the day that closes at the end of the day every day, and that would be a very nice day trading strategy. The other one I'm short on is Visa. Now, Visa was going downward and it was pumped up, and now on the dailies we've got this inverted hammer candlestick pattern that also eats up this green candlestick. So that's a bearish engulfing. Now the reason I am short on the VIX, short on Visa, V, is we have a gap right here. Now just like that SPY trading strategy where we short area gaps, we could do that with Visa, and we also come out with a very nice looking return on investment. So let's switch it around, SPY, Visa, run this algorithm and see what we get. What you get is 15% return, not as good as the SPY, and about 70% predictability. So it's not as good as the SPY. The drawdown's about the same. The return is much smaller, but still, if you look at it, let's get up here again. If you look at it, it does have quite a ways to fall from 77 to close that gap. So I mean, that's $200 for a swing trade. This would be a swing trade, not a day trade. Also, we're very overbought with Visa, so it's got to come tumbling down eventually, if not just for correction, then just overall. But it's probably going to be a correction. It's probably going to continue up in the long term. So I'm not saying be short on this for a long-term holding, but do be short on it until this gap fills. Once that gap fills, you can go long again. So I think that's it. If you have any questions, please leave them in the comments section below, and also like this video. Thank you.